Hey, good afternoon. Hello, everyone, and welcome to Construct Connect's second webcast on COVID-19 and its impact on the construction industry. Thank you for joining us today. This webcast is a collaboration of Construct Connect, the Associated General Contractors of America, and the American Institute of Architects. I want to begin this webcast the very same way we began our last webcast a few weeks ago by saying thank you to all of those who work in our medical industry. We are deeply grateful for the services that these neighbors are providing in our communities. Today, we're very proud to present an esteemed group of panelists. We have Ken Simonson, the Chief Economist at the Associated General Contractors of America, Kermit Baker, the Chief Economist for the American Institute of Architects, and Alec Carrick, our own Chief Economist here at Construct Connect. My name is Paul Hart. I work with our sales enablement and product marketing teams here at Construct Connect, and I'll be your moderator for today's event. Now, we want to get to our presentations and our Q&A as quickly as possible, so let's get a few administrative details out of the way. Please feel free to ask a question of one or all of our panelists at any time during the webcast. We're going to try to answer as many of those questions as possible. Many of you submitted questions as you registered for this webinar, and we're going to answer many of those as well. All attendees will get access to a free recording of this webcast, and in a few minutes, we will share some very important resources where you can find the latest information on the impact of COVID-19 crisis on the construction industry. The resources are free and available to anyone. We'll show you where to access those right after our presentations and before the Q&A section. Now, for AIA members, this webcast is registered with the AIA for Continuing Professional Education, and this begins the accredited portion of the program. All AIA members attending this live broadcast will be eligible to earn 1 CE Learning Unit credit. If you did not include your AIA member ID number when you registered for this webcast and would like to receive your CE Learning Unit credit from the AIA, please email your name and your AIA member ID number to jennifer.creighton@constructconnect.com. That's on the screen there now. jennifer.creighton@constructconnect.com, and we'll display this email again later on in our session. Okay, now let's get started. Back on April 2nd, we had our first webcast addressing the COVID-19 health crisis and its impact on North American construction. Much has changed in the past month. Many states and municipalities desperate to revive battered economies are moving to open at least some of their businesses and industries. But does this mean that we and our neighbors are ready to go congregate in the local barber shop or diner or bar yet? What about schools, right? So there's a lot that's happened in the past few weeks. There's a lot to consider. And our focus here today, of course, is what does this all mean for the construction industry? So let's get started with our presentations. We begin with Ken Simonson. Ken is the Chief Economist of the Associated General Contractors of America. He is a fellow and past president of the National Association of Business Economics and an appointed member of the Census Scientific Advisory Committee. His Data Digest newsletter is delivered weekly to more than 50,000 subscribers. He received a BA in economics from the University of Chicago and an MA in economics from Northwestern University. Thanks for being with us today, Ken. Welcome.
Thank you. Good to be back with you, Paul, and with many of the attendees again. Let me start by talking about the latest weekly survey that the Associated General Contractors of America has done. I think most of you are familiar with AGC. We represent more than 27,000 companies, 6,500 general contractors, and the rest are divided among specialty contracting firms and suppliers of equipment, goods, and services, such as architectural services. And we've been doing surveys since mid-March, quick online surveys. Today we are wrapping up our 6th in that series. The last couple have been bi-weekly, so we didn't wear out our welcome with everybody who was getting the emails about them. Anyway, on the screen, you can see the results of a survey we completed 2 weeks ago, and I'll run through that quickly and also make references to the near complete results that I saw last night for this week's survey. We saw a steady increase in the number of contractors, and all of these are percentages of respondents. They're not percentage of projects or percentage of workers or something like that, but the percentage of respondents, and there were almost 850 in the survey 2 weeks ago, close to that number this week also. A very substantial percentage saying that the owner had halted a project that was already underway. 2 weeks ago, that was 50% of projects. This week, we have already heard, and it's only, the 7th of May, at least 48% of respondents said that a project that was underway this month has been halted. More ominously, the percentage who say that projects going that had been scheduled to start in May or June or later have also been canceled. That project cancellation count has been rising. As of last night, 20% in the slide here, 16% 2 weeks ago. So you can see that cancellations are rolling in at a steeper rate. As you might expect, there are many reasons that projects are being delayed or disrupted. That percentage has held steady recently at about 2/3 of respondents. The leading cause of delays and disruptions is a shortage of personal protective equipment. But I'm glad to say that percentage dropped off a little bit. It's 33% in the survey 2 weeks ago, down to 28% of respondents. So I'm hoping that means that construction firms are finally able to get access to masks and other required gear to make sure that their workers are safe on the job. Pretty steady percentage, around a quarter each, saying shortage of construction materials, equipment, or parts, shortage of craft workers, and also a recent flattening out on the percentage of firms that say suppliers have notified them or their subcontractors that deliveries will be late or canceled. Just under half of firms are saying that is an issue. As you might expect, more firms have had to furlough or terminate workers, and only a small minority of firms have been able to add workers back. We did see that about 18% of firms 2 weeks ago and 4 weeks ago, 20% of firms this time said that they have won additional projects. Most of those were medical projects such as hospital remodeling, screening or testing facilities or labs. Highway contractors and utility infrastructure contractors, folks laying water or sewer pipes or cable. A small percentage of them said they've been granted more access or been able to work more hours because of the drop in road traffic. And I think that's also been true with a few airport projects too. But in general, I think the trend is downward. The one thing that has helped firms keep their head count is that the construction, more than any other sector, was able to get the PPP, the Paycheck Protection Program loans, when those first came out at the beginning of April. But now there's a lot of question about whether firms are exposing themselves to audit and prosecution because they may not wind up qualifying for the rather stringent requirements on maintaining headcount. That's obviously difficult in construction, where headcounts tend to fluctuate project to project, if not week to week in the course of a project. And there's also a lot of concern about liability, exposure to either tort liability or employment liability for contractors who go ahead and then a worker turns out to be sick, either one who brings an action or one who says, oh, I was exposed because they let a worker who was ill on the project. So we've been asking about what sorts of legislation firms feel are needed. And this is now the #1 concern in the survey that we're completing today. Let me move on to talk about the current impacts in construction beyond what's in the survey. We certainly for a while saw a growing number of shutdowns ordered by governors or some mayors. Construction associations, the AGC has 88 chapters around the country. Many of them were very alert and vigorous in letting their governors know that their orders were unnecessarily restrictive, and we did see in some cases some modification of those. So that part has stabilized, but we are seeing more and more firms say that we are running into cancellations. So I do expect for the rest of this year, we're going to see a shutdown of more construction activity. And that's on my next slide, the outlook for 2020. I expect to see almost no new private starts, except in the areas of improving home delivery and connectivity. So there may be some warehouse projects, some additional cell towers, some fiber optic cable laid, perhaps some 5G, and some data center enhancements. Contractors are getting, if they do have work still, they're certainly getting a break on fuel costs. The Energy Information Administration says that diesel prices are 77 cents cheaper than a year ago. And also many other commodities have come down in price. I think those price declines will last for a good while now, well into 2021. So let me shift to the likely mid and longer term outlook for construction. I think that as the economy opens back up, as governors allow more activity in their states, other industries will be way ahead of construction. Unfortunately, many firms are going to find that the customers they were counting on have either closed up shop, or they'll say, well, we no longer see the need to open another restaurant in our chain, or a state or local government will say, we had a lot of unbudgeted expenditures, we have a balanced budget requirement, our revenue is way down, so we're going to put off building that new library or school that we had in our capital budget for next year. So by and large, I think construction will be a lot slower coming back than the rest of the economy. Let me stop there and just mention that AGC does have a lot of economic resources, including many specific to the coronavirus. agc.org is our overall site. We then have a large of pages devoted to safety tips, to our legislative priorities, and to our survey results, agc.org/coronavirus. And as Paul mentioned, I write a weekly one-page summary of economic news relevant to construction called the Data Digest. Be glad to add anybody to the email list for that. Just email me at the address shown on this slide. So let me turn it back to you, Paul.
Thanks so much, Ken. Yes, I do want to plug that Data Digest just because there's always such great information in there every week. Again, you can find that email Ken, or you can find it at agc.org. I'd now like to welcome our next panelist, Dr. Kermit Baker, the Chief Economist for the American Institute of Architects. Kermit analyzes business and construction trends for the U.S. economy and is the project director of the Remodeling Futures program at the Joint Center for Housing Studies at Harvard University. He received his master's degree in urban planning from Harvard University and holds a PhD in the same field from MIT. Welcome, Kermit.
Well, thanks, Paul, and let me offer my welcome to our listeners also. If you could move on to the first slide, Paul, I'm going to begin with a brief overview of key economic indicators. The most useful indicators that we're seeing now are weekly indicators because the economy has been changing so rapidly, and I think will continue to change quite quickly. One of the key indicators is the weekly state reports of persons filing for initial unemployment claims, which totaled over 30 million earlier this month and jumped another 3.2 million with today's release of new claims filed last week. Still, we're seeing a bit of a divergence emerging between the so-called leading indicators and other that track current conditions in the economy. So leading indicators, I've got three examples here at the top of this chart, things like stock prices. They reacted very early and very intensely as the pandemic worsened, but recently they've leveled off. So stock prices probably have reached their bottom for this cycle and are heading back up. More traditional leading indicators like the fiber index here that I've showed has begun to level off, as have interest rates. On the other hand, the indicators that track current conditions, like the unemployment numbers, they're likely to continue to climb in the weeks and months ahead. We'll get a reading tomorrow for the April period. Oil prices, Ken mentioned those. They generally reflect the health of the economy. They were above $60 a barrel at the beginning of the year, and as you can see, below $20 now, and very volatile due to storage issues. And the unemployment numbers give us a pretty good perspective on the geography of this downturn, how it's playing out in different parts across the country. So what I've got here are unemployment insurance claims from the weekly state reports on unemployment insurance that I referenced in the last slide. There's been, with today's release, almost 35 million claims over the past 7 weeks, or almost 14% of the civilian labor force currently have unemployment insurance claims. Where are these claims concentrated? Well, these are the top 10 states in terms of the share of the labor force that have filed for uninsured claims, and some like Nevada are states that rely heavily on hospitality and tourism industries. Others are where the pandemic hit early and therefore shut down the economy a little bit earlier, like Washington, for example, New York, or Michigan. And states with the lowest share, and here's the 10 states with the lowest share of unemployment insurance claims, generally have just the opposite characteristics. Their economic base is often concentrated in agriculture or the extraction industries, which generally haven't been hit as hard, oil being one exception to that. They also tend to be areas that have lower shares of COVID-19 infections in the population, at least currently have lower shares of COVID-19 infections. Let me move on now to our architecture billings index. After bouncing around through most of 2019 and firming a bit later in the year and earlier this year, we saw a dramatic decline in March. As you can see here, this is our steepest 1-month decline in the almost 25 years we've been monitoring business trends at architecture firms. Our April figures are going to be released in a couple weeks, so we'll be watching those very closely to see how they compare to the number we saw in March. And backlogs at architecture firms, which are a measure of how much design work they have in-house, also dropped significantly in the first quarter. Backlogs averaged well over 6 months on average in 2019. They fell to just over 5 months with our most recent survey, and may head down even more in the months and quarters ahead. One question we're asking is how is this downturn comparing to prior downturns for architecture firms? And we generally see the severity of a downturn very early on with our architecture billings index. So the 2001 downturn, the solid red line here, the fall was fairly modest initially, tended to moderate a bit over the first 12 months. And that's what I've graphed here, the first 12 months of the downturn during each of these cycles. In 2008 and 2009, the blue line here, the drop off was more dramatic and then accelerated a bit towards the end of the first year. And this time, with just 1 month into it, just the one dotted line there, we're seeing a very sudden drop off initially in this. So this is really taking off much faster than either of the prior two downturns. Most architecture firms are expecting fairly significant revenue declines this quarter. In a survey that we did a little over a month ago, firms reported that revenue was down about 10% on average for their firms during the month of March. Now they're estimating that revenue will be down, as you can see, almost 17% on average for the second quarter of the year, with fully a third of firms reporting that they expect revenue at their firm will be down 25% or more during the second quarter of this year. And we're seeing a little bit of variation in this estimated revenue decline for the quarter. As I mentioned, about 17% nationally. Looking at region, the firms regionally, firms in the South and West are projecting somewhat smaller declines than firms in the Northeast and Midwest during the second quarter of this year. And larger firms are expecting a somewhat smaller decline, still double digit, but a somewhat smaller decline than smaller firms through the second quarter of this year. And let me end up with a quick discussion of our consensus forecast, our consensus construction forecast. We do this twice a year. We go to the leading forecasters across the country and ask them what they're projecting for construction activity for the upcoming 2 years in our December survey that we release in January, and for the upcoming 18 months for our survey that we conduct in June and release in July. Our December survey we released in January seemed so out of date once we got into March that we did a supplemental survey of our panel, just asking them very kind of in a general sense, because we caught them between cycles, of what they're expecting would happen in 2020. So let me run through those very quickly. The blue lines here are the dollars in spending in that sector, total non-residential buildings, commercial and institutional. The gray line is what was the consensus forecast as of the beginning of the year, and the orange bars are what's the consensus now as of our early April update. So heading into 2020, I think our forecast panel was expecting a very modest year in terms of spending on non-residential building activities. You can see up only 1.5%, hardly anything at all on the commercial side, a little bit stronger on the institutional side. But as of numbers that we generated just a couple weeks ago, they've obviously marked those down quite significantly, a little over 10%, 11% overall for 2020, and a little bit steeper on the commercial side than the institutional side. And as a final point, we did ask what were the 1 or 2 sectors that they expected would outperform others during 2020, and what were the 1 to 2 sectors that would underperform others in 2020. On the outperform, healthcare, almost unanimous in terms of the number of respondents that thought that would be picking up. Education, public safety also got a couple votes. This is of a panel of 8 firms. On the underperform, even more, I think consensus there, virtually all of them seeing retail and the hotel sectors underperforming the broader non-residential building market this year, and then a few other sectors also. Let me end up, Paul, by just reminding folks to check our AIA website for more resources. We are adding material daily to our website on trends that we're seeing in the market and the design professions that are really giving us some visibility in terms of the broader construction industry. And let me turn it back over to you now, Paul.
Excellent, Kermit. Thank you so much. Great insight as always. I really appreciate your perspective. Next, we're going to do something a little unusual with the unusual times. I'm going to actually present just a little bit of information, try to do this in under 2 minutes. We're running close on time here. So but we do want to share some insight that we are getting from our content team here at Construct Connect. So I've got just a couple of bullet points I want to share and then a couple of graphs. We are beginning to see new projects rise again. A month ago at our webcast, it was still going down. We just weren't seeing any new projects well, we were seeing new projects come in, but nowhere near the level of just a year ago. So we are beginning to see that uptick, that rise again. Now you'll see that in a graph on the next slide. While we are seeing more new projects enter the market, the value of those projects are considerably less over last year. And we are now seeing less changes in bidding projects. Those projects that were out to bid, you can imagine the projects that were out to bid back in March went through significant changes. Things were being pulled off, put back into planning, or the bid date was postponed, all sorts of changes happening to that. We're seeing less of those changes now, but we are continuing to see steady delays on construction starts. Here's a great piece of information. We're seeing more bid openings move to online announcements via web conference tools. An example would be the state of Wisconsin just announced that all bid openings for state administered projects will now be opened via Skype. Here are some of those graphs of some of the changes we're seeing. In the top left there, you see a rolling day totals of project event changes, and this is specifically the project event is projects placed on hold. That is coming back down. You can see the huge spike beginning in mid-March that ran through April and even into late April. It's now coming back down towards 2019 levels. You're seeing over in the top right, rolling 7-day total again of projects published. You can see the significant drop again beginning in mid-March when the crisis really hit. Things started to take shape here in the U.S. Stay and shelter in place orders going out, but those are rising again, coming to approach 2019 levels again. And then of course in the bottom, the rolling week average of daily bidding projects, after plummeting dramatically, is now beginning to turn upward. So that is a fast and furious report from the front lines of our content team. And now, as I always say, last but absolutely not least, our third panelist today is my colleague Alec Carrick, the North American Chief Economist at Construct Connect and the Chief Economist of Construct Connect's Canada Data. Alec is an award-winning writer whose articles and analyses are popular features of the Daily Commercial News and Journal of Commerce. His monthly construction industry snapshots are a must-read for anyone interested in the North American construction industry. You can find those in the blog section at constructconnect.com. Alec holds a BA in economics from the University of Western Ontario and an MA in economics from the University of Toronto. Welcome this afternoon, Alec.
Thank you, Paul. It's a pleasure to be here, and I will try to move forward here. The first slide that I've got, and I don't really have a lot of slides. I'm going to mostly talk as we get through this, but today, as on every Thursday morning, the initial jobless claims number is released, and today's figure was 3.2 million. So it's been coming down. The total for the last 7 weeks has been 33.4 million people, though, that have been added to the unemployment insurance roster in a little under 2 months. So next slide, please, Paul. Paul, next slide. Thank you. So these are the GDP growth rates, and there's two ways that the GDP growth is being presented these days. One is full year 2020 over full year 2019, and the other is quarter to quarter annualized. And the quarter to quarter annualized figure, that's the one that's so scary, because that's the one that will probably be something like minus 20%, maybe even as much as minus 30%. That'll come out in July. The year over year number, though, people seem to be saying, well, that's between minus 4% and minus 6%, and that's not as scary a number. Well, in actual fact, it is. It's a pretty darn scary number, because if you look at the history of GDP, you can see that in the Great Recession, the decline was minus 2.5%, and we thought that was a big deal then. So something like minus 4% or minus 6%, that's a big drop in GDP. Next slide, we have oil prices. And I'll be referring to this as I get a little bit further into the presentation. And you can see that there was a day in April when the price of oil actually went negative. Now it's back up around $15 US per barrel, but they're still a deeply depressed number. Okay, moving on to the tables. We can skip over that one and we can go to the next table. And okay, I guess this is kind of the focus of what I'll be talking about. because we just undertook our new starts forecast for the year and for the years out to 2014. And we concluded that the grand total decline in starts is likely to be minus 27.4%. And as I say, people are saying, well, the GDP number minus 4%, minus 6%, and put in place construction maybe minus 10%. So why is the starts number so much more extreme? Well, there's a lot of reasons. So that's what I'm really going to try to get into here. I think there's a fair amount of wishful thinking that's taking place. States are opening up, the economy's starting to open up again. I've heard some arguments that residential started the year great, and it did. Residential was back to 1.6 million units every month in the first couple of months of this year. And so why won't it go back there? Well, let me give you my thoughts on this. Residential started the year because it was supported by two pillars. One of them was an extremely healthy labor market and income increases. When you got really low unemployment and you got good jobs growth, you've got income increases. Well, as one of those previous charts showed, there are now 33 million people on the unemployment insurance roster. They're not all going to be hired back at once. And even when they are hired back, some of them are hired back, they're going to be working part-time as opposed to full-time. And by the way, those establishments that do come back, they're going to have trouble even meeting variable costs, never mind rents and all that sort of thing. So one of the chief underpinnings of residential has been removed, and that's the labor market. Another thing that was supporting residential was some degree of population increase. Now it's only been about 0.5% in the last couple of years, but there still was some increase, some gains going on. All of that increase came from immigration. And of course, immigration now, whether it be legal or illegal, has completely dried up. And there's other factors to take into account as well, such as if you own a condo that you're renting out and people aren't paying the rent, it seems to me that there are people who are going to want to divest themselves of those properties. And that's going to add to the supply of housing. So I just don't see how housing comes back to the degree that some analysts, some writers are saying that it will, or are hoping that it will. And then there's all kinds of other things to look at as well. There's whole industries in the economy that are just struggling to stay alive, like the airline industry and the passenger cruise lines and even hotels. I mean, the occupancy rate of hotels right now is down to about 80%. And then here's another thing to take into account. Last year, in the starts figures, there were a ton of mega projects of $1 billion or more each. There were 35 mega projects, and they accounted for 15% of the total volume of starts. Now, I don't think there's going to be anything like that kind of volume of mega projects in 2020. Most of those mega projects were in the energy sphere. And it was things like refineries and LNG projects. And with oil at $15 a barrel, Saudi Arabia and Russia have agreed to cut production by 10 million barrels per day. But the actual drop in demand because of the decline in industrial production around the world is still more than that. So the price of oil, price of energy it'll be gradually going up. But at this point, would you really be starting a mega energy project, maybe a pipeline or two? And then we come to the subject of infrastructure projects, because I've heard that there's going to be an infrastructure stimulus plan that may help to save the industry. Okay, let's look at the financing. Washington is likely to have a deficit this year of about $4 trillion. It was starting with $1 trillion before this pandemic even struck. And then there were $2 trillion proposal of money to help with a set of priorities that begins with income supplements and then topping up unemployment insurance, and then moving on to help large and medium-sized firms and rapid transit systems throughout the nation, and hospitals, and then small business, of course. There was a tremendous amount of money that was set aside for small business, $350 billion. And then that was raised to an extra $500 billion. And this is before you even get to state and local governments that need a lot of money. So I don't know where infrastructure fits in this. And actually the money's, the $4 trillion that we're talking about, that's almost replacement money more than it is stimulus money. And here's another thought with regard to infrastructure. China is going to launch a big infrastructure program. They have already announced this. But where they're going to spend the money this time around is not going to be on airports and roads and railways as in the past. It's going to be on telecommunications and high-tech projects. They're going to build hundreds of thousands of 5G base stations and tens of thousands of racks for data centers. And if you're looking to resource construction, this has implications because back in the 00s, Chinese demand related to infrastructure spilled or rippled out around the world to Canada, Africa, South America, Australia, in terms of the raw materials that went into building airports and roads and so on. But if the infrastructure projects are high-tech projects, there may not be the demand for raw materials that there have been in the past. So there are all these factors that kind of come together. Now our own actual starts through April, because when we did the forecast, we had the numbers through March, and in March, the grand total percent change was minus 9.1%. Through April, the grand total percent change is now minus 15%. And if you want to look at history, in 2008 and 2009, in the last recession, the declines in starts were minus 16% and minus 18%. So that's the kind of setbacks that we've had before. Now, before I just finish here, I've got a couple of other things that I might quickly mention. And one of them is, one of the things to really watch for as we come to the end of this year is how, I don't know, maybe half the country, maybe half the people in the country are going to be involved in a lawsuit of some sort, because everybody's going to claim that they've been harmed one way or another. It's going to be companies suing governments for going out of business, or it's going to be workers suing companies believing that they've been exposed to health risks, or it's going to be banks going after homeowners for mortgage delinquency, and so on. You can see this going up and down the scale. And if they're not involved in lawsuits, then there's going to be insurance claims everywhere. And then my final point, I guess, would be one of the things that's likely, one of the biggest things that's likely to come out of this whole situation that we're in is changes to design. So if I used to work for a trade association, and I know that the trade associations now are probably sitting down, getting their experts together to talk about necessary design changes, necessary code changes that can come down the pike in a couple of years. Things like bigger sidewalks, more sidewalk space, and more elevators and in office towers, and are all the amenities needed in high rises, high-rise condo units like common laundry rooms and so on. So code changes and design changes, watch for that as well, and be thinking about the code changes that you really think should occur, and how the product that you sell will fit into those changes. Okay, thanks. Back to you, Paul.
Thanks, Alex. Appreciate it. Great insight as always. I do want to point to a couple of resources for all attendees here that you can access for free at constructconnect.com. These again are resources that are important during this really extraordinary time. That you can find out more detailed information on the impact to the construction industry. We have our latest, the Q2 2020 forecast. It's available at constructconnect.com. It answers a lot of questions that we've seen coming in live on this webcast, and the questions that registrants entered as they were signing up for this webcast. A lot of you're asking about specific geographies. You're asking a lot of questions about certain building uses, sectors, categories. A lot of those questions are answered in that forecast report. We also have resources specifically about the impact of this crisis on the construction industry as far as essential construction and delayed projects. So you see here a section that we have at constructconnect.com that lets you know about delayed projects in select provinces, in select states, even getting more granular than the state areas of the states and provinces, where you can go in and look at and download a list of delayed projects in your area. Here's what those lists look like. So also more information on delayed construction deemed essential in your state or province. Now it is time for questions and answers. Again, all those resources are available at constructconnect.com. Let's get through these. We have just a few minutes left in the hour, so I want to get through as many as possible. I'm going to shoot out a first question to Kermit. Kermit, do you expect to see any changes where people want to live coming out of this? Urban city centers versus suburbs versus rural areas? As our experts on residential market, I would just like to know your thoughts on where you think maybe trends may change of where people may want to live coming out of this crisis.
Yeah, that's an interesting question, Paul, and I think we're seeing a lot of discussion on that. There's been a multi-decade trend towards urban living. More and more folks want to live downtown, particularly millennials. Closer to work, closer to restaurants, closer to shopping, closer to other entertainment opportunities. And suddenly all of those don't seem as important anymore, I think, with people not going out to restaurants, working at home and things like that. I think there's more emphasis, more incentives now for people to move to areas where there's more space, maybe fewer people, because suddenly we become afraid that maybe crowds of people can be an unhealthy situation. So I think we will see at least a short-term reversal of this trend towards urbanization and more focus on the suburbs. Longer term, I think it's harder to tell. When we return to normal, what does normal look like? And how much of the activity and behavior we've seen over the last 2 months will become part of our permanent behavior. And like I say, I think it's still early to be definitive about that. So I guess the quick answer to your question, I think in the short term, we are going to see a bit of more of a focus on suburbanization, where people can get more space, get a yard and things like that. That's sort of coupled with the fact that where millennials are getting married and having children, and I think suburbs are historically more attractive to young families. So, a short-term burst, and we'll see if that becomes a longer-term trend.
Excellent, great, thank you, Kermit. This really, I might bounce around to all of you. I'll start with Ken first. I'm trying to compile a lot of questions into a single question here, right? We've got a lot of these from our early questions and live questions online now. Everybody understands that this recovery, whatever shape it's going to take, is going to be uneven for construction, both by building use and by geography. So Ken, starting with you, I'd like to hear your thoughts on what sectors, what building uses, and maybe what geographies might recover sooner than others.
Sure, and this one is not in my area, but I've seen a couple of questions about it here. I think home remodeling is already picking up, partly because people have more time at home, and also they're realizing the need to provide better work or schooling or entertainment space in their houses. So a lot of that's probably do-it-yourself projects, although in my neighborhood in Northwest DC, I see a lot of subcontractors at work. So if you're willing to let a subcontractor in and they're able to get the supplies, I think that business is already going well, and I think that will continue and be one of the earlier parts of construction to continue. I think that school construction and water and sewer construction, while like every public sector, their funding has been hurt somewhat, probably a good deal less than ones that depend on specific excise taxes or passenger traffic and so forth. And the need is still there. We're probably many people eager to get their kids back into school as soon as possible. So I think that market will come back sooner than other parts of construction. In terms of urban, suburban, rural, I know a lot of people were thinking after 9/11, 2001 that big cities would empty out, and that didn't happen. In fact, in the last decade, cities started off growing faster than suburban areas, then inner ring suburbs. Now it's gone back closer to the historic pattern, but we're not seeing the ever greater spread to exurban areas. And I think that will be true again. I don't see much change in where people will choose to live within that spectrum. And I think that once people do have the chance to start moving again and job opportunities open up, they'll go to different parts of the country, as they have been in growth sets from the Northeast and the Midwest down to the Southeast and Texas, and from California, and more recently from Washington State to the mountain states, Idaho, Nevada, Utah, Arizona, Colorado.
Excellent. Thank you, Ken. And please mark me down as one of those who are anxious to get the kids back in school as quickly as possible. Hey, I know we were going to bounce that around. We just got so many questions. There's a great one I want to throw to Alec right now. Alec, how will construction recovery look different in Canada than in the US?
Well, there's going to be a lot of similarities. I think actually the Canadian economy isn't being affected to quite the same degree as the U.S. You know, the actual mortality rate, it's the mortality rate that's really the true indicator of how bad this is. The mortality rate in the United States per 100,000 people is currently 21. In Canada, it's 11. Now, if you take out New York from the US figures, that brings it down a lot. But in actual fact, Canada has not been as affected by this as the US to anything like the same degree. Now, one of the interesting things, though, is that Canada has long been talked about as having a housing bubble. We've been sort of famous. We've been covered in The Economist and a whole bunch of other magazines as Canada had this real bubble in house prices. Vancouver and Toronto were the areas where the increase in house prices were particularly noticeable, and governments took action to try and cool some of that. So I think we were pretty proud of the fact that everybody was saying we had a house bubble, but it didn't really materialize. But in actual fact, on account of this pandemic, it has cropped up, but in a different way than anybody anticipated. And it's appeared through HELOCs, home equity loans, home equity loaning. People have been piling on debt because the value of their homes has kept rising. So that's where some of the real danger lies for the Canadian economy, is the debt to disposable income ratio in Canada is something like 170%. And when you lose jobs, it's hard to carry your for interest commitments and so on. So housing starts in Canada for 10 years have hovered around 200,000 units. And I don't think it's going to stay that high. I think there's going to be problems. I think there's a lot of people owned Airbnb units. They're going to want to sell those. And in Canada, the thing that's really happened and really helped the Canadian economy has been population increase. I talked about population growth in the US being 0.5%. In Canada, it's been 1.5%. And again, immigration is nowhere. So I don't think residential is going to be as strong. And I don't think, and the resource side, who's going to be investing in energy projects with prices, natural gas is below $2 a million cubic feet, oil is $15, and actually it's West Texas Intermediate, the price of West Texas Intermediate, price of Western Canadian Select is what Canadian oil projects depend on, and that's half of West Texas Intermediate. So Canada still depends very much on strength in the US economy. And until that happens, I don't see Canadian construction performing a whole lot better than is happening south of the border.
Excellent. Thank you, Alec. I've got a couple of questions specifically for a couple of our panelists. Ken, I'll start with you. They're interested in your point of view, given all the surging traffic and sales and do-it-yourself space, right? The Home Depot, Lowe's, et cetera. Home improvement is already coming back really strong in pockets. We've already mentioned this, right? I think Kermit mentioned earlier, even the subcontractors, right, doing some home renovations. We have one attendee who says that seems a little bit in opposition to some of your point of view. We just want to know your thoughts on that. How's that DIY renovation coming back?
Oh, I don't think it's in opposition exactly. It's a different market driven very much by homeowners, and the AGC contractors do everything other than single family. So our members are responding to businesses, institutions, and government buyers of construction, and all of those, I think, are much more constrained in their budgets and their outlook for future demands. So it's consistent, but it is clearly a different market and probably going to do better than almost any of the ones that I follow closely.
Excellent. Yeah, that's a good clarification on those two markets. Thank you. Kermit, we have one for you. We have one of our audience members says that consulting engineers are still busy, as is university, hospital, and public education sectors. How can you determine there will be no more private starts? When engineers are busy, the contractors will be busy 1 to 3 months out. They want to make sure we're not promoting unnecessary doom and gloom out here. Do you care to respond to that, Kermit?
Sure, I'd be happy to. And I think you see construction is generally one of the last sectors to respond to a change in the economy because of lags. Our own research has indicated that design activity leads construction activity by 9 to 12 months. So, the numbers that Ken presented are fairly dire in terms of construction activity going on and projects put on hold. But I think in the near term, the construction sector will probably be stronger than the overall economy. And as the economy comes out of recession and begins to grow again, we'll probably see some weakness in construction activity. That's why we encourage folks to track our architecture billings index to see sort of the leading edge of that. And as I said, that really dropped off very significantly in March. And so we saw a pretty significant downturn. Number one, in design activity underway, and number two, I talked about backlogs, because that suggests if backlogs are declining faster than calendar time, it suggests that some design project activity is being canceled or put on hold. So it will take a while for all of this to percolate through the system. We're likely to see, as we generally do, the first impact on the residential side, next on the commercial industrial side, and then finally on the institutional side. And so some of those sectors are not going to feel the full thrust of what we're seeing in the broader economy for several months now. But I think it's pretty clear that they are going to feel it once it does percolate through the system.
Excellent, thank you, Kermit. I want to throw one to Ken here very quickly, just on inflation, deflation. We have one of our audience members that just wants to know, would you expect to see significant inflation or deflation in the future? What areas would you expect? Are there certain materials, labor cost, demand, sectors of our economy at large that may see inflation, deflation risks?
I think in general, this has brought down the rate of inflation. Many materials are suddenly much more abundant than they were. I think you'll find less demand for wage increases, more workers just looking to be rehired somewhere. So I know some people are worried about the huge amount of additional debt the government has taken on, but for now, I think central banks, including the Fed, are going to keep short-term interest rates down. I think the U.S., as usual, has a comparative advantage in attracting funds from around the world that will help help sell our bonds to others. So I'm not concerned about either interest rates or inflation for the foreseeable future.
Great. Thank you, Ken. I'm going to get one last question in here. Before I do, there are an awful lot of questions, again, about specific sectors, about specific states or provinces. I will remind everyone again, you can download our full Q2 2020 forecast at constructconnect.com. That forecast is built by Oxford Economics in collaboration with Alec Carrick, our chief economist. So please head over there after this webcast, and you can get some fantastic information about that for that construction outlook moving forward. It's a great document with lots of great information. Let me get to one last question here, and I will go around the horn with this one because I think it's a great question. I'll start with Alec. Alec, what are the indicators you will look at to tell you that we have caught up to where we were, that a recovery, that we are back to levels before that we saw before March of this year in construction at large? What's going to indicate we're back on those levels to you?
Well, actually, Ken started this in his presentation. You can't be looking at the monthly numbers or the quarterly numbers. You got to be looking at the daily numbers if you can. So there are some daily numbers. There are things like there's a website that shows flights that are taking off, and there's oil prices, and commodity prices are another one. And there's certainly the initial jobless claims one. In terms of construction specifically, I mean, what we'd be looking at is our own start statistics. We have those numbers that Paul reviewed as well, which are first appearance statistics to see whether the number of projects that are being that we're gathering information on, and then status change statistics as well. So we have a lot of statistics, but it's the general numbers on the economy, and then it's going to be employment. I mean, nothing's going to happen until the employment start to get
right
jobs, because 70% of the economy is consumer spending, and when you've got so many people who aren't working, you're just not going to have economic activity. So that's what you're looking at. You're looking at jobs.
Great. All right. Thank you, Ken. You did start that a little bit in your presentation. Is there anything you can throw out for us that you're going to be looking at to indicate recovery is underway?
I think Alec covered it pretty well. I'll pass.
Okay, great. Kermit, any last thoughts?
Well, I would say, the real question is looking at the leading indicators for the economy and where those are headed. And I think Alec did cover those. Those are things like stock prices, interest rates, housing permits, consumer confidence, things that suggest when things will start to get better again. Let me one more time say, I think our architecture Billings index and
Right.
Alec's construction starts are another leading indicator for the broader construction activity. So I think you want to see where it's headed. You'll know when it gets back to normal. I think that the key is trying to find out when it's going to get back to normal.
Excellent. Thank you all, gentlemen. We are at 1 minute after the hour. I want to thank our outstanding panel, Ken Simonson, Kermit Baker, and my colleague, Alec Carrick. Thank you for sharing your insights with us today. I also want to thank the brilliant Jennifer Creighton, Melissa Bookout, and Elizabeth Wilson for managing the production effort on this webcast. Thanks to all of you for joining us today. Please remember to visit www.constructconnect.com, where you will find an abundance of resources on the North American construction industry, including the latest information on the impact of the COVID-19 pandemic. We will be scheduling another webcast soon. Please keep an eye out for that announcement. Until then, this is Paul Hart at Construct Connect. Thank you very much for attending, and please stay safe, everyone.